Kelly Milligan and Mike Berry here for Quorum Private Wealth. This is our first half recap. Mike, it was quite a market in the first half. I think the one word to describe it is resilience in the face of all of this headline news. Amazing resilience in the markets. You want to take us through what the indices did in the first half?
Amazing resilience. In fact, the fact that we actually had a war begin, a spike in oil with inflationary pressure and everything else, all of this coming off a 3-year run, positive run in markets when you've had the S&P and NASDAQ coming off incredible runs the last several years, pretty much primed or expected overdue for a big correction. But what happened instead was a very resilient market with the S&P up around 10.2, the NASDAQ up about 12.5. And some other sectors actually came to life. We saw sparks coming up in not just technology, as you would expect, up around 20%, but industrials had about a 20% run. Energy, not surprisingly, with the spike in oil, came up about 20% as well. Consumer stocks did not do as well, mostly because of fears of inflation and so forth. But what was really interesting was the resilience, Kelly, and I think it's because there was a great broadening out in the market. And
not just the Mag 7.
Not just the Mag 7.
What drove the market the last 2 years.
Yeah, I mean, we're making this video now here in July, and during the month of July, some of those stocks that even sold off quite a bit. The S&P is still up markedly positive for the year. And you have Mag 7 stocks down as much as 20-25%. So it shows great resilience and a much broader rally throughout the market, which is something we've been looking for a long time, because there was big risk with such a concentration in just 7 or 8 stocks.
Yeah. And now small caps have really broken out.
We've seen a big rotation in the small caps, up and around the 22-23% range. That's a big move. And that's generally something you don't see until you start seeing a broadening out of participation of other stocks overall.
And that's smaller companies starting to see the productivity gains of artificial intelligence and a resilient consumer hung in there.
And they're generally the most sensitive companies because they're smaller, they're not as adaptive. Big companies with giant cash flows and repeatable businesses generally are much more resilient themselves. When you start seeing small caps, mid caps take off in a broadening market, that's usually a very healthy sign overall. And so I would say we're climbing a wall of worry.
Well, and what's driving this is earnings. I mean, earnings growth in the first quarter was up 30%, S&P 500 earnings. Earnings growth in the second quarter, somewhere between 23 and 29%. So for the full year, earnings growth at 23% year over year, that's amazing.
Amazing.
I mean, that's what drives stock prices.
And it shows, how not just resilient the market is, but the economy itself. So it is much more than just a technology-driven market. It's much more than just an AI-driven economy. The USA was firing a lot of cylinders. And when you have some of the shocks that we had along the way because of the war in Iran, we saw oil spike from $70 to as high as $120. It's come back since then, and as skirmishes pick up and go away, we're seeing it spike up again between 70 and 100, but you're seeing a real base at around 70.
And you would have expected with a conflict like that inflation out of control, gas at $20 a barrel or $20 a gallon. We didn't see that.
No, we haven't. I mean, definitely the consumer has been hit. Those especially that are more sensitive to the price of gasoline and oil products. But overall, the rate of inflation has still been handling somewhere around the 3% range, which is going to be interesting going forward. We have a new Fed Governor Warsh. She is thought to be a little bit more dovish on rates going forward. Can't really do that if you have inflation and you have oil up over around $100. He seems to be, showing that he's there as his own person and is going to make the right call for the economy, not for anybody else. So we'll look forward to see what happens there. The bond markets had a rough go in the beginning of the year with rates jumping up for a while, have calmed down since that time. Still with a 10-year bond in the 4% range. We have yet to see some real dramatic move in bonds to a lower level. Negative returns for the most part in bonds in the first half.
Yeah. But all this is in a backdrop of GDP growth in the economy coming in at probably around 2.1%. Unemployment at 4.2%, which is, again, resilient. What are we looking at in terms of risks for the latter half of the year? It really comes down to inflation. Inflation could pick up. Obviously, geopolitical risks. I mean, every day you open the newspaper, plenty of geopolitical concerns. Government debt is rising, so we're watching that.
You have an election coming up.
Yeah, the midterms are coming up, but ultimately, there's a 95% correlation between corporate earnings and stock prices. So that is what we're watching: is the consumer, is corporate earnings as they're reported, and bottom line, we reiterate our advice to clients, which is short-term market moves always happen in the market, and there's always plenty of things to worry about, the wall of worry. But investors who stay diversified, remain focused on their long-term goals, win out over time.
It'd be hard to imagine how well the markets would be doing if it wasn't for all these headwinds. Having a war that's dragged on and out of control, that is, very centered on the energy markets, which are, have historically always been a very sensitive thing for the overall economy. It shows you that I think that there's a lot more that has gone into the U.S. economy over the last decades as far as building out the different sectors in which they're all very profitable, they're all running very lean. Stocks predict future earnings is really what it is. That's what you're buying. You're not buying what they're earning today. It's what's perceived to be their future profits. And I think the market's telling you that the U.S. economy is in a very strong growth phase that could go on for the better part of this decade without slowing down too much. We're going to have corrections along the way. We've had a full correction this year already. We had a full correction of as much as 20% last year. If you weren't watching, you missed it. And it came back. But the market, I think the bottom line is what we're trying to say, has been very, very resilient, stay diversified, and I think we'll all turn out just well for the year.
I think that's great advice. The second half is going to be fun to watch. Thanks for tuning in, folks. We look forward to talking to you next time. Take care. Bye.